If you're transcribing right now, make sure to continue. All right, here we go. Hello, students of Finance 300. This is Brother Lewis coming to you related to Maria's Soup Shack, the Chapter 1 case study. Now, they provided you most of the information here, right down below, income statement information and balance sheet information. So we're going to walk through this. I'm not going to do all of this. I'm going to leave this certain portions to you, but the ones that are kind of fill and summarize type calculations, I'm just going to do. Right, so 5,000 here for revenue. Cost of goods sold for material is 1,250, and cost of goods labor is 1,500. Right, now we can summarize these. That's pretty easy. Now, gross margin is going to be your revenue minus your COGS, right? And your gross margin percent is going to be gross margin divided by revenue. So I'll leave that to you to do. Indirect labor is 350. Payroll tax now, it says 7% is already included. So you want to reference this 7%, and you want to apply it to your cost of goods labor and your indirect labor. Okay, so cost of goods plus indirect times 7%. Now you want to do a reference to 7%. You don't want to actually plug in 7% because maybe this changes over time. Who knows? Okay. Benefits is 100. Rent is 1,000. Utilities 150. Insurance is 50. Marketing cost is 25. Administrative cost is 50, and depreciation is 100. Now we can sum these. Okay. And voila, we got that. Now, EBIT, earnings before interest and taxes, is going to be your gross margin minus your total operating expenses. Interest expense is 100. Got that from right here. And your earnings before taxes, EBT, is going to be your EBIT minus your interest expense. And then your taxes is going to be your EBT times the 18% rate. Your net income is going to be your EBT minus taxes, and your net income percent is going to be your net income divided by revenue. So you'll take care of all that, and this is a standalone financial statement, does not impact your balance sheet. They will, even though theoretically it does, in real life it does. In this case study, they're two separate financial statements that they're having you construct. All right, so then with your cash, you're going to come over here to the case study. You're going to put in 1,700, 200, and 250. You're going to sum that all together, and you're going to get your total current assets. Your plant equipment is going to be 2,500. Your accumulated depreciation is minus 300, and you're going to sum that too. And voila, they've already got the formula in here for total assets, which is your current assets plus your fixed assets on this deal. So no need to worry about that. Even though it says you need to compute it. I don't know why you need to compute it if they've already computed it for you, but that's fine. Accounts payable is 375. Taxes payable is 175. We can sum this, right? And then your loan balance, long-term debt, loan balance is 0. So your total liabilities, I'm going to let you calculate that as your current liabilities plus your long-term. Your stock is going to be 3,600, and your retained earnings is 200. So the sum is straightforward. Now they've already got the formula in here for liabilities and equity. You'll notice that the two are different. Total assets must equal total liabilities and equity, but it does not. I usually like to have a little proof on my formula on my sheet so I know whether or not I am in balance. Right now I am not in balance. Oh, I'm not in balance, of course, because this total liabilities is not calculated yet. But once you do that, that should be 0, and you will be all good to go. Let me know if you have any questions. Bye.